When most people enter the stock market, the very first question they ask is extremely simple. Is this stock cheap or expensive? Almost every beginner answers this question by looking only at the share price on the screen. If the price looks low, they assume the stock must be cheap. But in reality, it is completely wrong. A low price does not mean a stock is cheap, and a high price does not mean a stock is expensive. This misunderstanding is one of the biggest reasons why beginners lose money in the stock market. The stock market is designed to confuse emotional investors. Prices move up and down every day because of news headlines, fear, greed, social media hype, and short-term speculation. If you rely only on price, you are not investing. You are guessing. In this video, you will learn how professional investors actually decide whether a stock is cheap or expensive. You will learn real valuation logic that focuses on business strength, earnings, risk, and expectations instead of emotions. This is a complete masterclass in stock valuation. And once you understand it, the way you look at stocks will change forever. Chapter 1. Price versus value. The most important concept in stock valuation is understanding the difference between price and value. Price is what you see on the stock market screen. It is the amount you pay to buy one share today. Value is very different. Value is what the entire business is truly worth based on how much money it can generate over time. Market prices change every single day. Sometimes they change every minute. These changes are driven by fear, greed, rumors, news, and speculation. The true value of a business does not change that fast. It changes slowly as the company grows, earns profits, expands, or declines. A stock can look cheap because the price is low, but actually be cheap if the company is strong, profitable, and growing steadily. Once you understand the difference between price and value, you stop reacting emotionally to price movements and start thinking like a real investor. Chapter 2. Understanding the business. Before looking at charts, ratios, or financial statements, the first thing you must do is understand the business itself. Ask very simple questions. What does this company sell? How does it make money? Who are its customers? Why do customers choose this company instead of competitors? A good business should be easy to explain in simple words. If you cannot explain how a company makes money to a beginner, then you probably do not understand it well enough to invest in it. Complexity increases risk. Strong businesses usually sell products or services that people will still need many years from now. They often have strong brands, loyal customers, or some advantage that protects them from competition. When you understand the business, you build a strong foundation. Without this foundation, valuation numbers mean nothing. Chapter 3. Earnings and profit quality. Earnings are one of the most important parts of valuation. Earnings show how much money a company actually makes after paying all its expenses. Real profits are what give a company value. Consistent earnings over many years are a strong sign of a healthy business. A company that makes profits year after year is much more reliable than a company that only talks about future growth but does not earn real money today. You should also focus on the quality of earnings. Are profits stable, or do they change wildly every year? Are earnings growing slowly and steadily, or jumping up and down? Companies with unpredictable earnings carry much higher risk. Strong and stable earnings increase the true value of a business over time and give investors confidence. Chapter 4. Valuation and expectations. Valuation is about how much you are paying for those earnings. One of the biggest mistakes beginners make is believing that a popular or fast-growing company is automatically a good investment. Popularity does not equal value. Even the best companies in the world can become bad investments if the price is too high. A stock becomes expensive when market expectations are unrealistic. When investors expect perfect growth forever, there is no room for mistakes. On the other hand, a stock becomes cheap when the market is overly pessimistic about a strong business. This often happens during bad news, economic fear, or short-term problems. Always compare valuation metrics with similar companies in the same industry to understand whether expectations are reasonable or excessive. Chapter 5. Growth and future potential. The stock market is always focused on the future. Investors are constantly trying to predict where a company will be 5 or 10 years from now. Growth plays a major role in valuation. If a company has strong and realistic growth opportunities, investors may be willing to pay a higher price today. However, growth must be sustainable. Growth based on hype, cheap money, or temporary trends is dangerous. When growth slows down, highly valued stocks can fall very quickly. This is why understanding future potential is critical. Growth can justify a higher price, but unrealistic growth expectations can destroy returns. Chapter 6: Debt and Risk. Debt is a hidden danger that many investors ignore. A company with high debt can look cheap on the surface, but that cheap price often exists for a reason. Debt means interest payments. During economic downturns, high debt can crush profits and threaten survival. Strong companies usually maintain manageable debt levels that can easily be paid using earnings. Lower debt reduces risk and increases long-term value. Always look at debt before deciding whether a stock is truly cheap or just risky. Chapter 7: Putting it all together. To decide whether a stock is cheap or expensive, you must look at the full picture. No single number gives the answer. A stock is more likely cheap when the business is strong, earnings are stable or growing, debt is under control, and market expectations are low. A stock is more likely expensive when the business is weak, earnings are unstable, debt is high, and expectations are unrealistic. Valuation is not about being perfect. It is about reducing mistakes, managing risk, and improving your chances of long-term success. Most people lose money in the stock market not because the market is unfair, but because they approach it with the wrong mindset. They chase tips from friends, follow social media hype, and react emotionally to short-term price movements. They buy when prices are high and sell when fear takes over. This cycle repeats again and again, and over time it destroys capital and confidence. Professional investors play a completely different game. They do not rush. They do not panic. They focus on value, patience, and discipline. They understand that the stock market is a place where money moves from the impatient to the patient. Instead of forcing trades every day, they wait calmly for the right opportunities when price and value are clearly misaligned. When you truly learn how to value a stock, everything changes. Market crashes stop feeling like disasters and start feeling like opportunities. Volatility becomes your advantage instead of your enemy. You stop guessing and start making decisions based on logic, facts, and long-term thinking. This masterclass was designed to give you the foundation that most investors never learn. If it helped you understand how to tell whether a stock is cheap or expensive, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss future lessons. And comment below if you want a part 2, where we will break down advanced valuation methods in simple, practical language that anyone can understand.